In this video, I'm going to teach you 4 strategies of how to get started with investing in the stock market. As good as it sounds, it's important to have the fundamentals in place so that you don't lose all of your money. So if you're serious about investing, make sure you pay attention to all 4 of these strategies. The first strategy is to set a budget for investing. So when you're starting to invest, it's important that you set aside a certain amount of money that you don't plan on seeing for months or years to come. The idea is to have this money grow and grow. If you need this money next week or next month, then you will be investing with impatience, which will cause fear, which will cause you to lose money. And before you start investing, it's really important to pay off your debt, so credit card debt, student loan debt, car debt, or set up an emergency fund. This way, if you ever need that money, it's not tied up in any investment. Now, when it comes to the exact dollar amount of how much money you should start investing, it really depends on an individual circumstances. You could start with as low as $5, $10. Investing anything is better than investing nothing. Next is to decide whether you want to do active investing or passive investing. You could also do a combination of both, but it's important to know the difference. Active investing is pretty much how it sounds. It's a hands-on approach to investing. You're constantly micromanaging your portfolio to see how you could get the most short-term gain. Passive investing is pretty much how it sounds. You're putting your money into something that is for the long haul, that will slowly grow, but it is less risky. Personally, I'm more of a passive investor where I like the set it and forget it approach, where I invest in an individual stock or an index fund or ETF and let it grow over time. I don't plan on taking my money out fast. Unless there is some issue, then I will, but I'm just letting it grow and I'm not trying to get a short-term gain. By the way, I'm David, and if you want wise money tips to build a wealthy future, hit the like button and subscribe to the channel. Next is to understand your investment options in the stock market. So when it comes to your active or passive investing strategy, these investments here are going to determine how you're going to invest your money. The first type of investment, and probably the most commonly known, is a stock. So when you purchase a stock, you're purchasing a share in a company. You become an owner for that company. You don't get to tell the company of what to do, but you have ownership in that company. And the value of your stock is determined by how well the company is that you're investing in. So for example, like Amazon is, at the time of filming this video, valued over $2,000. Therefore, if Amazon keeps growing and growing, then the value of your stock grows and grows. But you don't have to spend thousands of dollars on a stock. You could buy a stock such as Ford, which at the time of filming this video is around $5 to $6, and that's a really low one. And however much money you put into these individual stocks, if the company that you invest in, that you purchase a stock for, if it goes out of business tomorrow, then you lose all of your money and the stock disappears. The next type of investment, not as commonly known, is a ETF, exchange traded fund. So this is a group of stocks. So rather than just invest in one company where the company could go way up or it could go way down, if you invest in a ETF, then it could be 10 companies, 100 companies, 1,000 companies. If one of those companies fail and goes out of business, you don't lose all of your money. An ETF holds many individual investments bundled together, and it could be traded like a stock throughout the day for much lower than a share price of a mutual fund. With an ETF being a big group of stocks, there's nobody micromanaging all those stocks. It's pretty much set in there, and if any of the companies do really poorly, then they're just removed from that ETF. And because nobody is constantly managing this ETF, the costs are very low compared to a mutual fund, which is basically the same thing as an ETF, where it's multiple stocks bundled together under one price. Mutual funds are managed by humans, which makes the price a lot higher. And there's often a high minimum price that you have to pay for a mutual fund. Also, index funds are another example of these grouped funds. For example, the S&P 500 is the top 500 businesses or companies in America, and if any of those businesses are underperforming, they'll just replace it with the other companies that are doing well. Now, the funny thing is 9 out of 10 times index funds outperform individual stocks or people who are managing individual stocks under a mutual fund. So that means professionals who day in, day out live and breathe stocks, that means index funds such as the S&P 500 are outperforming them over a 20 or 30-year span. And that's the reason why I personally prefer index funds compared to individual stocks. Next beginner strategy is dollar cost averaging. Dollar cost averaging is a strategy of spreading out your stock or fund purchases, buying at regular intervals and in roughly equal amounts, and if done properly, then this could really benefit your portfolio. This is because dollar cost averaging smooths your purchase price over time and helps ensure that you're not dumping all your money in at the high point of the market right before the market dips. For example, let's say every month you're investing $100 month after month, whether the market is up or the market is down, you're just always gonna invest $100. So over the course of a year, you're gonna invest $1,200 steadily. Compared to, let's say you take that $1,200 and you think that there is a really good opportunity, so you invest a lump sum of $1,200 in the market, and since we can't predict the market or what's gonna happen, the market goes down. Now, this is what causes people to invest with emotion and fear, and usually they sell out of panicking and seeing the market go down. With dollar cost averaging, it's more of a passive strategy to ensure that you may put money in when the market is low or high, but you're still putting money in, and over a course of 10, 20 years, your money will still go up. The 3 benefits to dollar cost averaging would be avoid mistiming the market, it takes the emotion out of investing, and it helps you think for longer term investing strategies. And the next strategy is to get started today. So many people wait years and years or think that they're going to start investing in the future when they have enough money. Just a little bit of money now will grow over time in the future. And if you don't want to use your own money to start investing, you want to learn a little more or try to figure out a strategy, then you could do something called paper trading. Paper trading is when you are trading stocks, but you're using pretend money. So a lot of the apps that I have down in the spreadsheet down below, if you open those up, they have paper trading where you could buy and sell stocks and figure out your strategies so that you understand what you're doing before using your own money. And one of the lesser known Warren Buffett quotes that I really like is, someone's sitting in the shade today because someone planted a tree a long time ago. So I recommend plant that tree today so you could sit in the shade in the future. And if you want to learn how to get out of debt and build a wealthy future, you could click this video right over here. It goes through the 7 steps of how to do so, and I'll see you in the next video. Thank you for watching.